Good afternoon, everybody, and thank you for joining us for another Hamilton Wealth Partners Fund Manager webinar. My name's Kane, Baranow, and I'm a partner with HWP. The format for today's webinar will be the same as previous webinars. So I'll commence by reading a brief advice warning. I'll then introduce our guest speaker, and I'll hand over for about 20 to 30 minutes for a presentation. And then, as always, we'll open up for questions at the end. So make sure if you've got any questions throughout the webinar, just submit them in the taskbar below, and I'll make sure I relay those to our guest speaker at the end. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking account of your objectives, financial situation, or needs. You should, before you make any decisions regarding any information, strategies, or products mentioned in this webinar, consult your advisor to consider whether that is appropriate, having regard to your objectives, financial situation, and needs. So as I mentioned, today we'll be joined by Adam Murchie from Forza Capital. Now, Adam is a specialist in funds management and investment and has worked in the property industry since 2001. Adam's core skills encompass capital sourcing, investment structuring, and investment management. Adam has a strong interest in governance, sustainability, and philanthropy. He was the former vice president of the Property Funds Association of Australia, founded its sustainability committee, and is currently involved as a committee member for the philanthropic sub-fund of the Australian Communities Foundation. So with that introduction, I'd now like to hand over to Adam to give us a rundown on Forza and what they're seeing at the moment. So over to you, Adam.
Good one. Thanks, Kane. Thanks for the introduction. Hi, everyone. Really appreciate the opportunity to be part of this Fund Manager series. So by way of background, Forza Capital, we're a boutique property investment business that work exclusively with family offices, high net worth advisory groups such as Hamilton Wealth Partners and individual high net worth investors. So the business itself, we were set up in February 2010, but really the catalyst to this lay in behaviour that myself and my business partner, Ashley Wayne, witnessed in the lead up to the GFC. And quite frankly, put simply, what we had a fundamental issue with was a lack of independence, conflicted advice and structures, the influence of investment gatekeepers and vertical integration, poor structuring, and a lot of money changing hands unnecessarily. And ultimately, these outcomes were quite often great for the fund managers, but less so for the underlying investor. So what we did or sought to achieve was to be completely independent and director-owned. We wouldn't pay commissions. We sort of weren't interested in getting involved in vertically integrated structures. We wanted to deal with self-licensed advisory groups, not part of a dealer group. At the time, people told us that we were crazy and that we would get absolutely eviscerated by the market. But we had faith that market behaviour wasn't sustainable, and with time, that sort of model would eventually prevail. In addition, what we wanted was for our business remuneration to be heavily skewed toward performance, and with the bulk of our remuneration at risk. We thought that was a very, very important point that needed to be enshrined in everything that we offered. Quite frankly, it was a different approach at that point in time, but we bootstrapped ourselves. Ash and I funded the business entirely off our own savings, had conviction in our position, and we pressed on. The business still remains 100% owned by the directors. Ash and I still hold the bulk of that. But we worked together for 21 years, and now the next leg of our journey is helping our staff and others transition into ownership of this business, because that's ultimately what we want to see, that the legacy of Forza Capital is far longer than anything Ash and I have been involved with. So in terms of our team, we're a small but very dynamic team. We like being really nimble. We use that speed to market and our ability to turn decisions around quickly to great advantage. And we've been able to get ahead of the market and competitors on a lot of transactions for that very reason. Interestingly, we're structured differently to a lot of our competitors in that we're not generalists. So in the intro, I was referred to as being an expert in capital raising and structuring and investment management, and that is what I do. My business partner, Ashley, he's focused on the property side of the market. So he's dealing with the property and the agents and the day-to-day of that. We're both very involved in each other's lives, so to speak, but we try and be sort of masters of our own little universes. We think that as a skill set becomes really, really influential in the way we run the business. So, in terms of the way we've structured ourselves, We do standalone SPVs. Everything's the ability for an investor to pick and choose, and we really, eat our own cooking, so to speak. We take equity in our deals, and really the proof's in the pudding. Since inception, we've averaged a 21% net IRR for our investors, and we're averaging just shy of 70-odd% each transaction, again, net of all fees. So in terms of what we look for, it's a bit of everything, to be honest. We're sector agnostic, but we're really driven by the underlying opportunity that presents itself in any individual situation. We're always looking for what we call asymmetry, where you get an excess of return relative to the risk you're taking on. And then we overlay that with, I suppose, our research to really try and lock out downside risk. For us, the nirvana is, how do you capture the upside potential of an asset whilst locking out any potential loss to capital? And that for us is really where a lot of our transactions fall over. We understand the upside potential, but we can't hedge out the downside risk. So that's something that we're always constantly really focusing our energy on. In terms of our business, the way I explain ourselves is really what we do is sit at the intersection of patience and opportunity. It can be really frustrating what we do. A big part of our business is about what we don't do. There are a lot of deals that we walk away from, but at the end of the day, that's what we're about. It's, we prefer to regret the deal that we didn't do than the one that we actually did do. So a big underlying, I suppose, theme, and again, it was touched on in the intro by Kane, is sustainability or ESG. I know it's the sort of buzzword of the last few years. We find that somewhat intriguing in that ESG has come back to the fore again during the COVID crisis. The last time it was front and centre was just post GFC for those that were following ESG as a thematic at that point. We've always believed in it. We've been doing it now for 15 years, far before it became cool. But interestingly, we're not doing it for environmental or social reasons. For us, it starts with the G. It's all about governance. If you get your decision-making right and the rationale as to what you're doing and why, the E and the S fall into play, because really what it is, ESG isn't a sustainability framework, it's a risk management framework. So whilst a lot of people at the moment are using ESG as a lens for capital inflows, telling investors they've got policies and processes and committees for this, the question I have for them is, well, if this is a risk management framework, what were you looking at previously? And why weren't you looking at this previously? So for us, we really understand now how to use this to leverage outcomes for our investors. So as I say, in the first instance, it's about risk management, better decision-making, reducing the environmental risks that arise in property, whether it be through increasing insurance premiums, obsolescence of the assets, inability to attract tenants. And now we can use it to actually drive returns. We understand I suppose the investment fundamentals and the returns we can generate from solar, from batteries, from building upgrades. And we've built some really strong internal capabilities around this now that we're able to leverage in terms of repositioning our assets. And it's helping us with reducing those obsolescence risks, but also now in terms of the way these assets trade and the way we can position ourselves in the market and the tenants that we can actually attract. The photo and the image in the backdrop here is a building that we bought at the back end of last year in Brisbane, 200 Creek Street. And we actually were funded, the debt piece on this transaction was funded by the Clean Energy Finance Corp, which is the government sustainability arm. We've been engaging with Clean Energy Finance Corp now for near on 2 years around building out a vehicle to invest in these kinds of assets and really show the market the opportunity that's available through transitioning assets that really need to be repurposed and rebuilt. So we're taking this asset to a 5.5-star minimum neighbours rating. We're the only group in Brisbane that's taken an existing asset to a 6-star rating. We've just recently taken another relatively recent purchase in Brisbane in Adelaide Street. We just got a rating of 5.5-star neighbour stars earlier this week, and we've now got a pathway to 6 stars. So we've got a real sort of internal capability as to how we can use ESG outcomes to drive risk management and return optimisation for the investors. So that's a bit of background, I suppose, some observations on the market. That's why we're all on this webinar. Interesting for us is that this has really been a cycle around labels. And what I mean by that is there's been a lot of differentiation to what we would call conventional property. So think essential retail, which really is shopping centres and service stations. You've got healthcare, which has always been a thing, but there's been an extension to that, which is now life sciences. And then you've got childcare, which is almost become a completely new sector or asset class in property. What we've seen in these areas with these labels is there's been some distortive effects as well. So we've had we've seen instances of healthcare properties being trading as healthcare properties. Really, they're office buildings with a healthcare tenant. There's nothing specialised around the asset. So the question sort of becomes, what resilience do they have as a healthcare asset, because they're trading at a price premium because of that resilience. We've seen it with childcare, where really savvy operators have realised that if they actually pump their income, the rental that they pay, they can actually optimise the return they get if they're the property owner. So they might sell their building on their building on a 25 times multiple of the cash flow, whereas they can only sell their business on an 8 to 10 times multiple. So what does that mean? They pay more in rent and sort of push the asset value up the flagpole. And then what that means for an investor is, without that tenant, some cases they're paying 2 to 2.5 times what the asset's worth. So we've seen these distortive effects where people are backing themes, but when you really drill down into the sort of fundamentals of the sector and that asset in particular, it's not necessarily all it seems. And I think that's probably emblematic of some of what we're seeing outside of property too in other sectors. One interesting one for us, particularly now, we've been saying this for a year, now it sort of looks much more prescient, is around long WALE REITs being potentially a bit of a problem for investors. The reason being, as inflation kicks in, most of these vehicles have got fixed indexation, 2-3% per annum, inflation tracking at 5%, potentially more over the near term. So you're net out of the money in real terms. Then you've got, in some cases, no rental reviews during a long lease period, or rent reviews where there's a cap and collar, so they might only be able to go up 10%. So what that means is you're losing money in real terms on the way through. You don't get to revert back to market rents that are being driven by inflationary impacts, and then ultimately that all feeds back in to the asset valuation at the back end. So it's sort of effectively a double whammy. And that's one we haven't seen a lot of discussion around, but that's something that we have been watching for quite a while. The other part has been just, I suppose, a sheer focus on absolute returns. Our view is people have been playing significantly up the risk curve for marginal improvements in yield, and we're starting to see that unwind across the investment spectrum at the moment. We haven't quite seen it in property yet. It tends to operate on a little bit of a lag, but we do expect that there'll be a little bit of fallout from some of those positions taken, purely just chasing an absolute number. Interestingly, somewhat counterintuitively, we think illiquidity in this environment can actually be a friend. Certainly, we saw that during the GFC and COVID, where peak to trough, the listed markets had really, really savage downturns relative to the physical market. We think that we're probably entering another window like that now. The catch to that is that you need to ensure that the vehicle you're in, the illiquidity allows you to manage through the cycle and you don't lose control of it. Certainly our lesson that we saw, and it happened across the spectrum during the GFC, was those that maintain control of their assets came out of the other side and actually did fairly well. And I suppose the last point is, I think what we're going to see now is the differentiation between fund managers and investors. It's a subtle difference, but in our view, it's actually quite fundamental. Fund managers are about growing assets under management or funds under management, and investors are very hard-nosed and they're agnostic to the funds under management, and every deal has to stand up on its own 2 feet. And I think what we'll start to see over the next couple of years is a little bit of a demarcation between those aspects. To the next slide, this is one that was in the Fin Review a couple of weeks ago, and quite frankly, I fell apart reading this on the way into the office. I mean, the blue line here is industrial, and really what this chart is showing is the relative pricing of the various property sectors. So we've seen a complete inversion in the last couple of years from the traditional norm, which was that on a relative basis, industrial was the least valuable, through to sort of, in commercial and retail invert a little bit, but they were generally sort of, on average, similar-ish. Industrials just had this absolutely manifest downwards trend in their cap rate, and when that just got supercharged around 2020 of COVID. Now, I suppose the question we've got is whether that's structural versus situational. We don't have a particular view at the moment, but just this this chart reminds me of the yield inversion bond charts that people reference. I just question whether there's a bit of mean reversion that may play out here. And I mean, just that dislocation for industrial in 2021 to where we are now relative to the other sectors is just huge. You literally need 20 to 30% rental growth today just to bring you back to the same relative return to the traditional office and retail investment classes. So in terms of what we're sort of seeing and doing and looking at, I suppose the headline point is office isn't dead. I could do a thesis on this. We've spent an inordinate amount of time looking at it, but the office construct is changing. Certainly internal fit out from a tenant perspective is changing, but that was already changing pre-COVID. We had seen a compression of the workspace ratio per employee for 2 decades. And in 2019, we have started to see for the first time in 2 decades that start to turn around and the space per employee was increasing. That's important because what it means is in this environment, if you go from 1 person per 8 to 10 square metres to 1 person per 10 to 12, you're talking about a 20 to 50% increase in space per employee, which means that you need to reduce your headcount just to maintain your existing office footprint. That's a pretty important point when you overlay with this whole concept of working from home. Some of these organisations need to rebuild their space and have a chunk of working from home just to maintain their existing footprint. We saw some really fantastic data about 8 weeks ago where they did a Monte Carlo analysis on what does it actually mean in an ability to reduce your office footprint if staff work from home 2 days a week. And the takeout was you could only reduce your footprint by 10%. Now, when you factor that into your business, the cost benefit of reducing your footprint by 10% for all the fundamental other issues it can cause just isn't worth it. I mean, your office costs in a human capital business are 10 to 15% of the overall operational cost. So you're playing at the edges, reducing your floor space per employee. Recruitment feedback is that business owners are quite frustrated. They want people back in the office more often than not, but it's a bit of a staring contest at the moment. They don't want to force the hand because they don't want to see mass resignations. It's very hard to replace people. The other thing that's got our interest at the moment are cost pressures and supply chain issues. It's across the board. What it is doing is distorting supply. Supply in commercial office and retail and industrial had already been curtailed when COVID hit, and this is curtailing it further. And what it's meaning is that the economic cost of delivering new supply has probably increased somewhere in the order of 15 to 20% over the last couple of years. So what that means is that these buildings now need to get 15 to 20% more rent before they can actually become viable with future supply into the market. And we think what that does is create an upwards pressure on rents for all the incumbent players. So that's certainly something that's really attracting our attention at the moment. We're spending a lot of time understanding where are the winners and the losers here. Part of then the knock-on or the derivative effect for us is if we think there is rental growth potentially in the system, we think that's highly likely medium to longer term. How do we get exposure to that today? And ideally what we're looking for are what we call sort of income producing strategic land sites where they have a positive exposure to this future development potential, because what happens is small movements in market pricing have multiples in terms of the effect at the underlying land level. So we're trying to sort of look around in areas where there's constrained land and there's a supply-demand imbalance as to where we can deploy some capital where the opportunities present. And I suppose the last one that we've really been looking at in particular, it goes back to our ESG thing, but don't underestimate the impact of property in the changing dynamics of energy. Property is going to have a big part to play here. It can be a producer through things such as rooftop solar farms on major land parcels and the like. It can be a store in so far as battery storage in these buildings. It's going to be the shock absorber that the infrastructure market needs in order to help transition to decarbonise the economy. And then the third bit is it can be in the supply side as well, which is pushing energy back out through EV charging and through discharging batteries into the electricity market. So again, it's a bit of a risk reducer looking at the future opportunities in property, but it also creates opportunities for new revenue streams. And to us, that looks really interesting. And we're trying to sort of bring ourselves ahead of the curve here to understand how we can leverage existing and future assets into this dynamic. So pretty wide-ranging overview there, Kane, I suppose, but a little bit of an insight into the business and sort of our views on the current market and the opportunities.
That was really good. Thank you very much, Adam. Yeah, so like I mentioned before, if you've got any questions, just submit them in the with the Q&A button, and I'll relay those to Adam. I might start off. We've had one that was pre-submitted by Michael. He's asked, and this might be a good opportunity actually to touch on the Forza Priority framework. He's asked the Forza Priority framework was established just after the pandemic. You were targeting returns of about 10% when you first launched this. 12 months later, you reduced the return target to about 8% as the adverse impact of property prices, it didn't eventuate. In this current environment with higher inflation, higher interest rates, what sort of return targets do you think are realistic looking forward?
Start with an easy question, It's honestly a question I don't have an answer to right at the moment. I take it on notice. And the reason I say that, it's like the great saying, when circumstances change, I change my mind. Is that up for review? Absolutely. Absolutely. But I mean, let's touch on what that whole priority framework was, because that was something that hadn't been done before and was a little bit of a construct. It started as a thought bubble for me in April of 2020 when COVID hit. We'd been here before. We knew what we thought was going to happen in markets was that there was going to be great dysfunction and great dislocation. So what we wanted to do was get ahead of the curve by having capital behind us ready to go to deploy when the opportunities present, because you don't have the luxury of time. And having capital there that you can point to helps avail the opportunities to you, because at that point, vendors and agents are looking for the path of least resistance to a deal. So we went, and basically what it was effectively was a handshake deal between ourselves and our clients. So we'll provide you with priority access to investments if you give us a commitment to capital. Now, it wasn't a blind fund. We weren't raising that money up front. Effectively, what it was people would commit a sum of money, and then the obligation was on us to go and find a deal and put it back to them. And if the deal was good enough, they'd participate. Now, the rough metrics were, even though there was no compulsion, we had about a 90% conversion rate of the equity that got committed to that framework. And that was $240 million of equity. Now, we haven't spent all of it. In fact, there's quite a bit still that we haven't allocated. It rolls off mid this year, and I'd say the likelihood of us allocating it is very slim. But really, it was a great response at the time to the market, and it was a vehicle that hadn't been done before. We did see a couple of straight-out copies of it, which I suppose they say, imitation is the greatest form of flattery. It was a bit flattering, a bit frustrating at the time, but nonetheless, it was what it was. And then, have a look at what happened during COVID. So the dysfunction wasn't there, and then it was quite the inverse. We needed the same dynamics behind us, the capital available and the ability to have speed to market, because there was so much money that got primed into the system that we needed it to remain competitive. So it was quite ironic. We laboured over what did we do. We raised money on the basis of a completely dysfunctional market that was probably entering a period of great distress, and we saw quite the opposite. So we actually had to go back to the investors and reset the whole vehicle in order to take advantage of opportunities the other way, because we did see opportunity there, but we still needed to move quickly to get in ahead of this capital that was trying to find a home. We did adjust the rates at that point because of the velocity of money. IRRs were coming down the curve. I think that cycle has ended. Arguably, we are seeing some softening, and it is fair to say we'll be looking at reviewing those hurdle rates. Investing is a relative game, so we need to look at this both relative to the risk of the deal and then relative to the risk within the market.
Thank you. You touched on just then. You raised 240 million of equity, and you found, I think it was 3 really good deals, and that there's also quite a bit sort of left over, which you don't think you'll tap before I guess the expiry of the framework. Is there anything at the moment that you're finding interesting out there, or which areas look the most interesting at the moment?
I mean, I think market conditions at the moment are just interesting period. We're spending a lot of time trying to understand just how this plays out. I mean, interest rates here are going to have a significant impact no matter which way you look at it. I mean, to give you some context, 6 months ago, we were drawing 3-year money at 65 basis points, and now it's about 330. So we've had, we're looking at deals where we had total interest rates in, swap and margin of 2.8%, and they're now low to mid fives. So, that has to get priced in at some point. We're not seeing it in price softening just yet, but it is going to temper what the market does. So that for us is probably the most interesting thing at this point. I mean, obviously we're looking at industrial. We sold out of our industrial at the back end of last year. We felt it was too good to be true. That might be prescient timing, it might not, but the thing that really is catching our eye at the moment is office. We just think that there's a lot of headlines, negative headlines around, office being dead or never being the same. It's not playing out that way. What we're seeing on the ground is very different to what is being reported. There's just not the vacancy there. It's higher than it was, but there was 200,000 square metres of sublease space that's effectively gone. Vacancy is fairly benign, even though people are saying that working from home is staying forever. And across our office portfolio, we've got a fair bit of office. We're seeing no real impairment to occupancy, and we're certainly having no problem with renewing leases. So at the coalface, we're finding the market quite robust. And so we like this dynamic where we think longer term, the market conditions today are reasonably good, but there's a degree of impairment still around the pricing. And longer term, we think there's actually conditions starting to build around rental growth. So to us, that's a spot we're spending a fair bit of time on. And then, as I say, looking at some of these longer term strategic land banks, there's potentially an undersupply of future residential housing, certainly in the middle rings around infrastructure, and we think those pressures will continue to build.
Thank you. You touched on leases and how you're renewing leases at the moment. You also spoke previously about long WALE REITs and the challenges faced with some of those. How have you structured leases to date? And are they linked to inflation, or what sort of percentages are and aren't?
Yeah, good question. We have been trying to pivot our leases from fixed to CPI. I got some great intel about 18 months ago now from an investor of ours actually who works in fixed interest, saying you need to start looking at reverting to CPI indexation because there's some real inflationary pressure coming down the channel. We've tried. We find that there's a fair bit of market pushback to CPI indexation. It's a bit of a balancing act. You don't want to throw the tenant under the bus in order to get that inflation exposure, I suppose. So where we can get it, we're trying, but it's probably 50-50 at best in terms of being able to get CPI indexation into leases. For us, the bigger thing is getting the rent where we need it to be, and then managing, I suppose, the other cash flows. And in particular, I think the big thing to navigate at the moment is the interest rate exposure. How do you actually set up hedges? We've historically always hedged our debt. The maturity of all of our funds would have between 3 and 5 year fixed debt. At the moment, that's an interesting trade. One of the things we're looking at is if you went naked on your hedge today, how long do you have to hold the position before you're net out of the money, based on the current forward curves, and what happens if those curves don't materialise? So they sort of all inform each other. And this is why I say it's really going to be interesting, because there are a lot of moving pieces to the puzzle at the current time.
Yeah, thank you. Maybe just one more on rents. You've spoken previously about how rents are they're going to have to do a lot of the heavy lifting moving forward. How are you factoring this into the types of tenants you're trying to attract? Surely these tenants have to be able to afford these higher rents, in their costing moving forward. Like, are you focusing on certain types of tenants, or, how are you factoring that into?
We're focused on tenants that aren't disappearing on any given day. So, I mean, we do a lot of homework on the strength of the business, but then the security that underpins the lease. So, bank guarantees, directors' guarantees, those kinds of things. To the question around can tenants afford it, it's an interesting one. I mean, if you look at the rental differential between Melbourne and Sydney, for example, it's huge. It's really significant. And largely in Melbourne, that has borne out of the fact that for 20 years we had negative tension to rents because we had this uncapped land supply in docklands that was literally given away for nothing to a range of different developers. Sydney had a sort of similar dynamic with Barangaroo, but the one difference was it was in the control of one developer, Lendlease. So they drip fed it to the market and maintained rents. Sydney also had a bit of a dislocation a few years ago now when they took a lot of commercial office out of the market when it was already tight for their new metro rail tunnel. So they had a real spike in rents. But a lot of businesses are national businesses. They can afford to pay the rent in Sydney. There's no reason why they can't pay to Melbourne. Melbourne rents basically are cheaper than Brisbane. And so there are a lot of markets where, quite frankly, the tenants can pay more rent, but they just haven't had to. And if you don't have to, you don't. So the last few years have been great for tenants because they've been able to pick and choose where they wish to occupy, and they've been able to get super competitive deals. But our counsel to clients that are business owners looking at taking leases are negotiate the best, longest deal you can get at the moment and lock it in, because we think now's a good time to be a tenant. And you want to sort of push out your market exposure for as long as possible.
Great. One last one from me, and as I mentioned, if anyone's got any questions, just submit them in the taskbar. I have to ask this: residential property. Have you got a gut feel on how where that's heading and interest rates? There's a lot of views out there that the market pricing is way ahead of where the RBA will eventually end up. Have you got a gut feel for the broader residential sort of market?
Look, we're interested observers, I suppose. In the main, we don't really focus on it. I mean, I do find it somewhat amusing where the headlines are around 15 to 20% falls in pricing. Well, I mean, on a relative basis, you've given up 1, maybe 2 years of gains. So it's not the end of the world. To the point in terms of what happens now with interest rates and the market. Last time there was a major market correction in the commercial property land, I remember going to residential auctions thinking there's going to be a bloodbath here. This will be horrific, and the market took off because people felt that residential property was a safer bet than some of the other asset classes. And I remember saying to my wife at the time at auctions, going, are these people even reading the paper? Like literally Rome is currently burning to the ground. And the psychology at that point was completely different. Do I think that'll prevail this time? No, I think the interest rate dynamic is very different this time around. But I don't know. I just think people need a bit of a reality check that a 15% fall in the market isn't necessarily a bad thing. The market needed a breather after the few years that it's had. I mean, it got way ahead of itself in terms of pricing. I certainly just, bit of sport. I probably, like everyone else on the weekend, looks at the auction results just to see what's happening. And it's fair to say I've been scratching my head for a little while now to it and wonder how people afford it. But that being said, somehow they just keep affording it.
Oh, well, thank you. Yeah, thank you very much, Adam. That was really good, and thank you, everyone for listening in at home. I hope you've gained some valuable insights and enjoyed hearing a bit more about Forza and what they're seeing in the property market. If you do want some more information, please feel free to contact us, and we'll happily send this through. So yeah, once again, thank you all for listening at home, and I hope you enjoy the rest of your day. And thank you again, Adam.
Thanks, Kane. Thanks all.
Cheers.